Hello everyone. Let's begin with the first reading, The Building Blocks of Risk Management. It's a very simple reading. It talks about what is risk, the different types of risk, the risk management process, the measures, and some advantages and disadvantages of them. It's very simple. It's very introductory. Let's go through it and keep marking as I go along. You'll see a marked, underline written down. You should write everything down so that, like I said, it's helpful right before your exams when you're revising. So let's see the first line. In an investing context, risk is the uncertainty surrounding outcomes. So, what we need to understand is risk is not loss, risk is not something bad. Risk is just the uncertainty that a future event might impact us negatively. So, we need to prepare for it in the present. Warren Buffett has said that the biggest risk is not taking any risk. So, you need to take risks if you want to earn returns, which from which we come to the second point, which is that there is a risk return trade off. What it means is that if you want to earn a higher return, let's say if return was here and risk is here, if you want to earn less return, then you can take less risk. If you want to take a higher return, you have to take higher risk. So that makes this a risk return trade off. And one more important point that I've written over here is that happiness from 1 unit profit is less than the sadness from 1 unit loss, which is very obvious and understandable, because since if you gain 10% on your portfolio, that happiness, if it were quantifiable, so to say, would be much lesser than the sadness from your portfolio falling 10%. It's very simple, everything. Don't need to worry. And in the last line, it says that the concern is the variability of the loss, especially an unexpected loss. So we need to differentiate losses or risks into expected and unexpected. So let's say a bank has given out loans worth $1 million to 100 different businesses, and the bank expects in general over the course of decades that the bank has been functioning, expects a loss rate of 3%. Let's say out of 100, three people will default and they will not be able to pay their obligations. So the bank expects 3%. So it can create a provision for this 3%. Obviously, it can provide for this and prepare for this in advance. So this is an expected loss or an expected risk. But what if 4 or 5 people default? And that is unexpected loss or unexpected risk, which the bank is concerned about, which businesses are concerned about, and the variability of these losses, which we'll study as we move along. And the example that I've written here is the Archegos Capital $20 billion loss that was faced by banks like Nomura and Credit Suisse in March of 2021. You should read about these case studies. I'll keep on giving examples of these, and you should keep reading about these to get a general scenario of the market. I'll only give recent examples for your understanding. Then we move on to the risk management process. So this process has 6 small steps that you need to know. You need to identify the risk, obviously what risks are there. People sit together, a group of managers, and they talk and discuss and they brainstorm what risks can impact you. For example, if it's a firm that invests a lot in agriculture-based firms, agri-tech, etc. So it needs to consider weather as a risk element as well. And there are a lot of factors that they need to consider. I've just given an example is weather. Second is you need to measure that risk. Now, obviously, now that you've identified, you need to measure the extent to which that risk will impact your organization numerically, so that again you can provision for it the 3% that I said earlier. The third is to distinguish between expected and unexpected. Yeah, some points are a continuation of the others, so you distinguish between expected and unexpected. Unexpected risk, some unexpected risk can be expected as well. We'll see that later. You can somehow quantify unexpected risks as well. The fourth is address the relationship among risk, which is the symbol of this relationship here means correlation, and the symbol of this is rho, the Greek word rho. And this is one of the most important concepts in risk management that you'll see everywhere. You see it in this chapter itself 3 or 4 times. What it means is that, let's say a bank has a division which has calculated risk at say 10 million, a forex division, let's say, and the other is an interest rate or bonds division which has a risk of, let's say, 10, another 5 million. So together you'll say the bank overall has a risk profile of 10 plus 5, 15 million, but that is not always the case. The risk can be, when put together, they can be as high as 30, 40, 50 million. But you'll say, how can 10 plus 5 be 30, 40, 50? That we'll again see later. It is due to the effect of correlation between the two departments. Fifth is to develop a strategy. Now that you've known, you calculated, you've address the relationship, everything. Now you develop a strategy by which you can mitigate this risk should it arise in the future. And the last one is to monitor the risk. So now you've developed your mitigation process. Now you need to keep updating this system that you've put in place, and you need to keep updating yourself also, and need to keep it in check. That's all. And now we'll discuss some of these points in detail. So the first one, like I told you, in identify the risk, a group of frontline managers, they sit and brainstorm. That is 1A. The second one is a quantitative approach in which we calculate something called a value at risk, VAR, which we'll see as we move along. And the third is a more qualitative approach, which is scenario analysis. So let's say, again, let's move back to March 2020 when the COVID pandemic was striking all the economies and shutting everything down. So in that scenario, you saw that volatility in the markets was rising, uh, purchasing power was falling, manufacturing was falling, and almost everything, people were dying, unemployment was rising, and everything was being pushed to extreme. All parameters were being pushed to their extremes. So that is what is forms the crux of scenario analysis. That you push all the variables in your model to extremes, and you see in an extreme situation what is the maximum loss that a bank will face, and then you provision for it accordingly. The next part, this tree sort of, again, risk can be divided to three types. Known knowns. So the first known is for you know about it, that it exists. The first known over here. And the second known talks about whether you can calculate it. So known means you know about it and can calculate it. So it is basic expected loss, unexpected loss, and all these figures that we see. Second one is you know about it, but you cannot quantify it. Known and unknown. Unknown. Second one, so unquantifiable, which is the loss from an earthquake, maybe, let's say. You know that an earthquake might strike, but you can't quantify the magnitude or the extent of it on your portfolio. And the third one is no unknown unknowns. Anything can happen. Let's say COVID was an unknown unknown. Not for some people, there were movies, etc. You may say, but let's call it an unknown unknown for now. And I obviously can't give you an example for that. So now the risk management process, as it says, involves a four-way decision, which is you can either avoid the risk entirely, you don't enter that line of business, or you don't take up that investment. But that is not ideal. You won't get that return if you don't take any risk. Like I said, or like Warren Buffett said, the biggest risk is not taking any risk. Then the second point talks about you may retain the risk entirely in your firm if you expect to earn higher returns or you want that risk. Let's say you're in some line of business, so you'll have to take on some credit risk or the other things. The third one talks about you need to mitigate the risk. So let's say the bank, which had given out loans to 100 businesses of 1 million each, to mitigate the risk, it can reduce its portfolio to, let's say, only 50 businesses. So that is a form of mitigation. There are other forms as well, but this is the simplest form. And the fourth one is transfer of risk. The bank can take an insurance on, let's say, if the number of losses exceeds 4 million, like number of defaulters exceeds 4% of their portfolio, then they will get a certain amount from insurance company. There are products like that, structured products. We'll study that later as well. Now we move on to the challenges in the risk management process. The first point talks about the risk must be sufficiently dispersed in the economy. So what happened in 2007-9, the example that they mentioned is that risk was too concentrated in some banks like Lehman and the others. They had a lot of structured products. Don't worry about the terms that I'm using of structured products, etc. It'll be clear by the time you finish all my videos. And what happened was that if 10 people take a little risk, it's okay. All 10 won't fail. All 10 might suffer a little bit, but it won't fail. But what if one person takes that risk and 9 people don't have any risk? So 9 people might survive, but that one person will fail, like that one bank did, or a few banks did fail. Investment banks, large investment banks, one of the largest investment banks failed. The second one is corporate governance failure. So there are a lot of corporate governance failures which can extend to rogue trading or insider trading, or let's say accounting fraud and manipulations that can occur. And there is no way you can provision for this, or there might be ways, but it's really difficult because the managers who are supposed to manage the risk are creating this risk themselves. So it becomes a really complex situation for the firm. The third point is the inaccurate information. So what happens is that some people don't know how much risk entails in derivative products. You don't know the extent to which some people think that, like, let's say I was talking to someone the other day and they said the market can't fall by more than 20% in a day. But there have been instances, Black Monday, Black Friday, etc. Market has fallen by over 20% in one trading session. And it doesn't need to be happening every month, every day, every year. It just needs to happen once, let's say once in a decade or even once in a century, and it'll wipe out hundreds of thousands of people's entire net worths. So that is again a challenge in the risk management process. The fourth one is risk transferring. So what happens is that you take an insurance, so the risk got transferred from you to the insurance company, or the bank took an insurance on their portfolio, like I said. So the risk got transferred to another bank or insurance company or whichever entity they insured it from. So the risk remains in the economy. It does not get entirely removed unless you're taking the first step of avoiding the risk. Then even then, maybe someone else captures your market. They are taking the risk. So what this point says is that risk is never entirely eliminated. It only gets distributed. Risk is a zero-sum game. So now we will move on to the second point, which was measuring and managing risk. So the first one, like I said, was brainstorming. The second here, which is mentioned here, is quantitative measures, value at risk. So what it talks about is that I'll explain it to you first. Let's say you take 1000 monthly return data and you order them from smallest to largest over here. One second. Yep, so you've ordered your monthly data from smallest to largest over here from minus 26.69% to 29.29%. Now, what you do is you take the 50th data point, which is 5% over here and 95% over here. So you get your 50th point, which is minus 15.5%. So you can say that over a 1 month period, since these are monthly returns, with a 95% confidence, that is, in 95% of the cases, your losses don't exceed 15.5% of your portfolio, whatever that value is. Here they've taken 1 million, so your losses don't exceed 155K at a 95% confidence, and you need to mention the time period, which was not mentioned in the first line, which I've given over here. So at a 95% confidence level over a 1 month period, you need to mention both. So that is the crux of value at risk. You just order your data, you take that 50th or 5% or whatever percent, you take that point and you say that at that point, whatever. So now don't ask me that what if it's an even number, and so you take the average of 50th and 51st, blah, blah, blah. That's pretty simple. I'm not explaining. But now we move on to talking about the drawbacks of VR. It's mentioned later, but I'd like to talk about it here. What do you think the drawbacks of VR would be? So let's say this is 15.5%. What if this was minus 76.69%? Or anything, it could be anything. So you're entirely ignoring this part. You're just taking this point. What if this was a small figure, let's say only 5%, and this was 70% or 20, 30%. And that one case, that huge loss figure is realized. In that case, what do you do? So VR completely ignores that part, and that is a huge drawback. So for that, what we do is we employ something called the expected shortfall, which takes an average of these 50 datas. And again, there are drawbacks to that as well. It is better. It gives you a figure around somewhere here usually when you take an expected shortfall figure. But again, there is a drawback that only these figures over here, they will cause your firm to cease to exist. So you need to give more weightage, or you need to lay more focus on those. So there is again something where you give more weightage to the losses, higher losses, and you give lesser weightage to the smaller losses and frequencies, and there are improvements upon those as well. Next, let us move on to economic capital. So now, like I said, the 155K figure that we had. So if the bank maintains 155K in their reserves, there is, with 95% confidence, they will not cease to exist within any 1 month period. So that is economic capital with a 95% confidence over a 1 month period, the 155K. Now, like I explained scenario analysis earlier, many variables, all variables, you're stressing all the variables to extreme ends, and it's the worst case scenario that the bank can face, and then you calculate the loss in such a scenario. Then there is stress testing where you only push one variable to the extreme, push one parameter to the extreme, and judge its effect. And you also judge the frequency or the possibility of this event occurring in a short term or long term, and things like that. Just read through, it's pretty simple. Next, we come to the crux of the risk management process. Every organization or bank nowadays has these. It's called the enterprise risk management. You go to any bank's website and see their enterprise risk management, the process, the steps they've implemented. It's pretty interesting. So what happens is that, let's go back to that bank we had discussed, with 10 million forex risk and 5 million bonds risk. So when you take them separately, it's 10 and 5, but if you take them together, it could be greater than 10, greater than 15, sorry, or it could be less than 15 as well if they are negatively correlated and they offset their risk somehow. So what we need to consider is a top-down risk management process where you calculate the risks individually, but there is a top framework, a risk management framework at the top, which cumulates all their risks, consider the correlations and all pairwise correlations of tens of twenties of numbers of divisions, and they consider pairwise correlation and consider a loss figure, expected loss figure or unexpected loss figure for the entire firm as a whole, the enterprise-wide risk management. Now again, we move to expected loss. I've spoken about this many times. There's just one additional thing. So expected loss is equal to exposure at default. Exposure would be the 100 million, the probability of default, which is 3%, and this LGD is the loss given default. So let's say three people have defaulted, but they don't, the entire 3 million is not lost. They pay some of the money back, even if they pay 10%, 20%, but they pay some amount back just from their bankruptcy proceeding. So this 20, 30%, whatever, you get it back. And the 70, 80% you don't get back. So that 70, 80% is the loss given default. So let's say in this case 70%. So out of 3 million, your loss given that these people have defaulted is 70%. So your actual expected loss is 2.1 million, not 3 million, which I had originally told you. And again, the professor's note says the same thing which I told you, that the banks can provision for it since it's a predictable expense. Usually, three people will default with a 70% loss given default rate, and the bank is confident of it since it has years of data with it. And this is called the prudence concept in accounting, where you be prudent that these might be expenses, so you already provision for them. Now, unexpected loss, you need to use the variance of the loss and a number of other figures, and the calculation for this will come later. It's not mentioned over here. There is also a correlation risk. Like I said, 10 plus 5 is not always equal to 15 in risk management. So you need to consider the risk of correlations changing as well. The correlations might change. So that is also a risk. It might increase in a stressful situation like it happened in 2007-9. Correlation shot up to a great amount that banks had not expected. The next LO again talks about the relationship between risk and reward. This is the crux of it, that as you take more risk, there is a probability of higher return, or if you want to earn higher return, you need to take more risk, but there is no guarantee that you'll earn higher return. There is a probability. Let's move to this line, which I've underlined over here, this one. When risk tolerances are high, the spread between riskless and risky bonds may narrow to an abnormally level, which again disguises the true relationship between risk and return. What this means is that risk tolerance. So, who would have this risk tolerance? It will be you as a person or a bank. So, if a bank has a high risk tolerance, what does tolerance mean? That it can tolerate a very high level of risk, let's say. So, for them, a bond which is returning, let's say, 3% treasury bond, which is almost riskless, it's considered riskless. Let's say US treasury bond is returning 3%, and a corporate bond is returning, a corporate bond of, let's say, Apple, if it issues, is returning 4% or 5%. But the for the common people, they may think that Apple is almost riskless, but there is some level of risk and their risk tolerances are very high. So that true relationship of the risk in Apple, the bond of Apple, may be disguised because people may think that 5% and 3% has no difference in the risk sense. So you rather go for the 5% without realizing that there might be a case of a stressful situation in any company. Enron used to be one of the largest companies of the firm. In fact, I'd seen a video of Ben Netanyahu wherein he said that about 10 years ago, five of the top 10 companies were energy companies, and today, five of the top 10 companies by market cap are uh, tech companies, and it might change in the next decade. Anything might happen. So you can't be sure because these bonds are issued for 10, 20, 30 years. So you can't be sure about that at any point in time. There is a risk always, even in some countries, not maybe not USA, but some country bonds also, sovereign bonds are also at risk. Okay, just go through. It's easy. Nothing to talk about in this LO. Read through it. Now we move on to the types of risk. So there are seven basic types of risk that we need to understand, and all of the risk types and everything fall under these seven types, and we'll study about it. Each risk type will almost each risk type will have an entire subject or an entire book in part two. So pay attention, and once your basics are clear, it'll be easy for you. So the first one is market risk, where it talks about the different market variables such as interest rate, equity price, forex, and commodity price risk. And let's see the first one, which is the interest rate risk. It talks about the uncertainty in the changes in interest rate on price level. So let's say you have bought a bond for $1,000 at 5%, which is giving you a 5% interest every year. And next year, the interest rates in the market rise. Interest rates become 7%. So, do you think your bond will still be valued at $1,000? Obviously, no, because your bond is only giving 5%. Whereas if I take a bond in the market right now, it will give me 7%. So your bond's value has obviously gone down. The price has gone down. And banks have hundreds of millions of bonds and other instruments, interest instruments, which we'll study about later. So the banks need to consider the risk of an interest rate change in this aspect. The second one is the equity price risk. Now you all obviously understand that the equity market has a huge level of risk. Again, moving back to March 2020, when COVID struck, the equity markets were blown for 2 or 3 months. There was complete panic in the markets and huge selling, and the markets were crashing, 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 tumbling. So again, equity price risk can be divided into two parts. The first is general market risk, and the second is the specific risk. So general market risk, what it means is that there is general fear in the market. If there's general fear, like in COVID case, if there was a general fear in the market, or let's say in general also, if the entire industry is performing badly, then it's not your company specific, any company specific factor that is causing your stock price to fall or do better, so to say. But what specific risk says is that your company is doing something specifically great, which is causing your company to do well. General market risk is called systematic risk. It's not systemic, it's called systematic. And the specific risk is called unsystematic risk. Remember these two terms, they'll be repeated later on. The third type of market risk is forex risk. Again, banks have branches in different countries, they have businesses in different countries, and they're dealing. For example, let's say Jaguar in UK is owned by Tata Motors, which is in India. So it's earning revenue in pounds and sending that money to India, to Tata Motors. So that entails a huge amount of forex risk for them, since that profit or revenue for them is in hundreds of millions of pounds. The fourth one is commodity price risk. Again, similar to equity price risk, but it's a little different, but it's again similar. There is a huge volatility in the price of commodities, precious metals, timber, etc. And people trade in these commodities, and banks also facilitate uh, large let's say aviation firms in hedging their prices. You'll study about this later again. So this is again a huge risk for the bank. The second one we move on to is credit risk. So credit risk refers to a loss suffered by a party where the counterparty fails to meet its contractual obligations. So let's see the third and fourth first, then I'll move to the first one. The third one is a downgrade risk. So what happens is that banks or entities, when they issue bonds, let's say, they are given a rating A, B, C. Let's consider them A, B, C rated for now. So a C rated bond has a higher risk, a B rated has a lesser risk, and A rated is fairly less risky. So might it might be possible that you've taken a bond of a company rated B, and a month later, the agency which rates them, rated them, changed their rating to C. So now their credit risk has increased significantly because the credit rating agency, which collects a lot of data, considers them to be more risky. So that is again a credit risk for you, because if the rating falls even further to D, then the company might default. D stands for default, wherein the company might default on your obligations. The fourth one is settlement risk. So in derivative transactions, what happens is that, okay, let's say not let's not consider derivatives. Let's take an easy example. Uh, yes, yesterday I saw a Euro Cup match, and I said Team A will win. My friend said Team B will win. We bet $100 each. You should not bet. I don't bet. But let's consider an example: $100. So after the game, my friend's team won, and I didn't pay them. That is settlement risk, because we didn't know who will win at what time. So at the end of the at the end of the contract, we didn't know who would win. So when his team won, I didn't pay. Or maybe if my team had won, he wouldn't pay. So that is a settlement risk that we have to bear. Again, no gambling. Don't gamble. I don't gamble. Now, on the first two, default risk and bankruptcy risk, the difference is that you've given a loan to someone, they fail to pay your obligation, but the company or the person is still solvent. They have not declared bankruptcy and completely shut down. It's just that they cannot pay your that obligation right now. They are still functioning, and this happened with a lot of companies here recently, and you can look it up, defaulter companies and etc. The second one is bankruptcy risk. So in this case, the company has completely gone bankrupt. They will never be able to pay you almost anything. You might get salvage something out of bankruptcy proceeding, but that's it. And the company will usually never function again unless it is restructured by the bankruptcy code or anything that exists in that country. So let's move on to liquidity risk. So to explain, let me give you the example of the 2007-9 crisis first. So what happened in 2007-9 crisis? So let's say I am a bank. Took a one-day loan from here, and I invested in a 30-year asset over here. Why? Because I get a one-day loan for 2% per annum, and I can invest at 5 or 6% per annum, for example. So I earn that difference, 3 or 4%. So now you might think that I'll have to pay him back after one day, but that is not the case. I'll roll over. I'll say one more day, one more day, one more day. I'll keep rolling that over. And it's not like I'm asking him for one more day to pay him back. They know that it'll be rolled over forever, and they are ready to invest that 2% in my firm because they are liquid funds. So now what happens is that, what if the value of this asset starts falling for some reason, this bond? For some reason that we'll study again later, the value of the asset is falling and my credit worthiness is going down. So this person stops rolling over that loan. They say, no, give me back my loan. No more rollover. So in such a case, this is called funding liquidity risk. I am not getting any funding anymore. It is not possible to get any funding anymore. And this is the crux of the example also given over here. Mismatch between assets and liabilities, because my liability is one day and my asset is 30 years. So there's a mismatch. If I have to sell it right now, it's going to cause a huge problem, which comes to market liquidity risk. So now the market for this asset is not liquid, as in not many people are there to buy this asset anymore now that its value is falling, and in general also the resale of this asset is difficult. So now to sell this asset, for let's say there's a house that I want to sell urgently, but obviously I cannot sell it at its fair value. if I want to sell it urgently, like you will want to negotiate, you will want to look at other buyers. If I'm selling it to you, you will want to look at other dealers, and you will it'll be a long process. But if I have to sell it urgently, let's say it's a house worth 1 million, I'll say, okay, I'll sell it to you for 800K. You'll readily buy this house. But again, I'm not selling it at fair value. I'm selling it at 20% discount to you, which is why you're readily buying it, so that you can immediately sell it in the market after all the negotiations over 1 month and get 1 million or even more. Or you might want to leave it and you're getting it at a 20% discount. So, otherwise, this is market liquidity risk, that you cannot sell your asset at fair value. So, what happened was that the value of this asset is falling. He's asking for his money back. Now, I have to sell this asset at even lower value and pay him even less amount. And this is worth hundreds of millions. And it took a huge, huge toll on the bank. And ultimately, Lehman Brothers failed, Bear Stearns failed because of this liquidity issue. The fourth one is the operational risk. It refers to the losses flowing from inadequate internal processes, human errors, or external events. So, there might be an employee mistake in entering some data. There might be a technology failure. There might be a cyber attack. There might be a rogue trader. You should read up about Nick Leeson. He was a rogue trader. That is, he took huge positions using the bank's money, which he was not allowed to, and he lost that money. And ultimately, Barings Bank, one of the oldest investment banks in the UK, failed because of that one person's mistake. The fifth is legal and regulatory risk. So the difference is that legal risk is that there are laws already prevalent, and one of your employees or your firm is breaking those laws. For example, tax fraud or other accounting frauds, other form of rogue trading is also a type of fraud. So you're breaking the present laws. The second one is regulatory risk, which means new laws will come up that will stop you from doing certain continuing with certain functions in your organization. That is again a huge risk for huge organizations. So let's say Facebook antitrust. That is why we call them antitrust regulations, not antitrust laws, because they are coming up, they are being debated on, etc. The sixth one is business and strategic risk. So business risk is that there is a risk of prices of inputs, demands, etc., which the business needs to take. It usually cannot hedge against these risks, and the business needs to retain this risk, which was the second point in the risk management process. The second here is strategic risk. It talks about long-term investment decisions. So let's say you want to buy a huge machinery for $10 million, and someone comes up, a second seller, and he says, "I'll give you a machinery, the same machinery, for $9 million. It's just that it's one quality lower. Let's say that one's grade A. This is grade A minus, and you think that you're saving 1 million, but you shouldn't readily go into that transaction because there might be some clause in the deal, or that machinery might fail or stop working after 1 year. So the business needs to consider all of these risks as well, because it's investing for the long term, 10, 20, 30 years. It's investing a huge amount, 10 million, 9 or $10 million for such long time. So the business needs to consider this strategic risk. The last one is reputation risk. Now, in this social media world, you cannot say anything to anyone at any time. You need to be very diplomatic in what you're saying, in what you're doing, and it might cause a loss in confidence with the people. For example, recently, when companies started speaking about child labor in cotton in China, people started boycotting Nike and other H&M and other companies. So Nike had to issue a statement and apologize, after which things settled down. And Nike has been in some issues even earlier as well, because Nike directly employs child labor as well in some low income countries, etc. And there were videos of people burning their shoes, very stupid. So that is basically reputation risk, nothing to explain much. So next one is risk factor interactions. Again, this entire hello talks about the correlation risk, which I've spoken about twice earlier. It is very important, and 10 plus 5 is equal to 30, 40, 50. Anything is possible. 10 plus 5 is equal to 10, 9, 8. Anything is possible, and you need to consider the interactions and convolution between them while aggregating these risks. There are a lot of methods. There is volatility, etc., which you need to consider. The last one again talks about the drawbacks of the VR. Like I told you, the third point is that VR only determines that threshold level that the losses cannot exceed 15.5% with a 95% confidence. So, what if it there is a huge loss figure, like I said? The first point over here is there are a few different versions of VR. So, everyone uses different versions. Some people use credit VR, only market VR, and other things. The second one talks about that there are several simplifying assumptions. So, let's say your 95% figure is very huge, 15.5, but your 94% figure is very small, say 5 million. So the manager will think that let's tweak this so that they can earn a higher return on that. They won't have to keep that extra economic capital in reserves just because of 1%, but that 1% might take the whole firm down. Again, it talks about expected shortfall, like I said, nothing to explain. So this is again risk adjusted return on capital. Like I said, the manager wants to maximize that the return they earn on the economic capital. So they want to keep as low economic capital as possible. As the denominator goes down, the figure will go up, obviously. So they want to have low economic capital, but it's not ideal. That's all in this reading. Just go through it once. It's pretty simple. Do the questions. They're pretty easy. Look at this question. Question 2. It's important. Read the answer. That's all for this reading.